72 hours. That's all it took. Not a year, not a month. Just 3 days to erase more wealth than most nations create in decades. No sirens, no emergency alerts, no breaking news banners screaming across your screen. Just silence. And then, $10 trillion vanished. This wasn't panic. This wasn't fear. This wasn't a market correction. What happened was precise, surgical, executed down to the minute. Gold collapsed, silver imploded. Fortunes evaporated while the world slept. And the most terrifying part? It wasn't accidental. By the end of this story, you'll understand why this wasn't chaos. It was choreography. When markets fall, we are trained to accept simple explanations. Too much speculation. Overheated prices. Healthy corrections. Those words are comfortable. They help people sleep at night. They allow systems to remain unquestioned. But sometimes the damage is too large to dismiss. In 6 hours, not days, not weeks, gold lost 15% of its value. Silver lost nearly 40%. Entire portfolios were erased before lunch. Traders who had spent years building positions were liquidated before they could react. Margin calls detonated across brokerages worldwide. And yet, nothing happened. No war, no terror attack, no financial institution collapsed. No global emergency was declared. Even more disturbing, the media barely noticed. $10 trillion disappeared and the world shrugged. That's the problem. Because when destruction happens without a cause, when losses appear without a trigger, it forces a dangerous question. Was this really the market acting freely? Most people never ask that question. They assume markets are chaotic, emotional, unpredictable. They believe prices move because millions of independent actors make random decisions. But what if that belief is wrong? What if markets don't just react? They are directed. What if the biggest losses never happen by accident, but by design? Over the last 50 years, something strange has repeated itself again and again. Every time precious metals surge high enough to threaten confidence in paper currency, the same pattern appears. Sudden rule changes, liquidity withdrawals, forced selling, and violent collapses. The players change, the excuses change, the outcome never does, and regular people always pay the price. The real problem isn't volatility, it's ignorance. Because when you don't understand the mechanism, you blame yourself, instead of the machine. What if I told you this event followed a script written weeks earlier? What if I told you that the sell-off didn't start on Friday? It started quietly, behind closed doors, with policy signals most people ignored. What if I told you that the biggest buyer in the silver market deliberately stepped aside at the exact moment collapse was guaranteed? And what if I told you that while retail traders were being wiped out, the world's most powerful institutions were quietly accumulating the very assets you were forced to sell? Because that's exactly what happened. This wasn't one mistake. It was a sequence. Tuesday laid the foundation. Thursday created the euphoria. Friday delivered the execution. Every move depended on the one before it. Every reaction was anticipated. Every liquidation was calculated. Most chilling detail? Physical metal never moved. Vaults remained untouched while paper prices collapsed. Screens showed panic, but reality showed stability. Two prices for the same metal existed simultaneously, and they were worlds apart. That contradiction alone should stop you cold. If prices reflect supply and demand, how can real metal trade at one value while paper trades 40% lower on the same day? The answer is uncomfortable. It means one price is real, and the other is an illusion. And illusions are easy to destroy. Before this is over, you'll see why this exact playbook has been used 3 times in 50 years. You'll see why it always happens near month end. You'll see why margin rules change quietly before crashes, and aggressively after. Most importantly, you'll understand why precious metals are attacked so viciously whenever they expose the fragility of the system itself. Stay with me, because once you see the pattern, you can never unsee it. To really understand what happened, you have to step back before the collapse, before the red candles, before the panic. This story does not begin on Friday. It begins quietly, when almost no one was paying attention. Tuesday morning felt ordinary. Markets were open, analysts were talking, news cycles were spinning as usual. The president was speaking, delivering what sounded like another routine economic statement. Most people barely noticed. It blended into the background noise of politics, something to half listen to while scrolling on a phone. But inside trading floors around the world, that speech landed very differently. One sentence changed everything. The idea of a weaker dollar. To the average person, that phrase sounds technical, abstract, harmless. But to anyone who understands markets, it's a signal. A weak dollar changes the entire equation. Commodities priced in dollars rise, gold rises, silver rises, always, without exception. And within minutes, the reaction began. Hedge funds adjusted positions. Currency traders started shorting the dollar. Asset managers increased exposure to precious metals. Retail traders, watching prices accelerate, jumped in late, chasing momentum. By Tuesday afternoon, billions of dollars were already committed to the same trade. Everyone was on the same side. That's when a market becomes fragile. Wednesday only reinforced the belief. Prices climbed higher. Charts looked unstoppable. Analysts framed the move as a new era for metals, a structural shift, a long overdue repricing. The narrative locked in. By Thursday, the rally turned historic. Gold reached levels no one had ever seen. Silver didn't just rise, it exploded. Social media filled with screenshots of gains, predictions of unimaginable price targets, stories of overnight fortunes. Influencers spoke with certainty. Fear of missing out replaced caution. People went to sleep Thursday night feeling like they had finally cracked the code. What they didn't know was that the environment had already been engineered for collapse. Behind the scenes, pressure had been building for weeks. Margin requirements had been raised quietly, step by step. Each change forced traders to use more cash to hold the same positions. Most barely noticed. Prices were rising fast enough to hide the danger. That's how traps work. They don't look like traps until they close. Friday morning arrived before most of America woke up. Coffee brewed. Alarms rang. Markets hadn't even opened yet when the headline dropped. A new Federal Reserve Chair nominee. To most people, it meant nothing. Just another name. Another bureaucratic appointment. Another political update. But to professionals, it was a shock. The nominee wasn't neutral. He wasn't flexible. He wasn't a supporter of easy money. He was known for one thing, defending a strong dollar. That single announcement erased the signal from Tuesday. In less than 72 hours, the message flipped completely. Traders who had shorted the dollar were suddenly exposed. Traders who had bought metals were suddenly on the wrong side of policy expectations. And when leveraged positions are wrong, they don't unwind slowly. They unwind violently. Selling began immediately. But here's where the story takes a darker turn. Normally, when precious metals fall, buyers appear. Value investors step in. Industrial demand absorbs supply. And most importantly, one massive buyer has historically acted as a backstop. This time, that buyer vanished. At the exact moment when the market needed liquidity, margin requirements rose again. Cash demands increased. Algorithms detected imbalance. Stop-loss orders triggered automatically. Margin calls were sent out across brokerages. Traders didn't choose to sell. They were forced. Prices fell fast. Then faster. Psychological levels that everyone believed would hold collapsed in minutes. What looked like a decline turned into a free fall. But while screens showed chaos, something strange was happening beneath the surface. Physical metal wasn't moving. Contracts were trading at enormous volume, but vaults remained untouched. No mass withdrawals, no physical dumping, just paper changing hands at lower and lower prices. That's when the truth became unavoidable. This wasn't a market rejecting silver. This was a market transferring ownership. Paper sellers exited under pressure. New buyers stepped in quietly. The price collapse created an entry point, not for the public, but for institutions that don't trade on emotion. While retail traders watched accounts evaporate, the largest players in the system were doing the opposite of what panic suggested. They were accumulating. Not on screens, not with leverage, with physical assets. And the gap between paper price and real-world price told the story clearly. On the same day, the same metal traded at dramatically different values depending on whether it was a contract or a bar. That doesn't happen in healthy markets. It happens when one layer is manipulated while another remains grounded in reality. The timing was no accident either. Month-end pressure mattered. Balance sheets needed to be cleaned. Liquidity had to be freed. Positions had to be closed before accounting deadlines. This exact pattern had appeared before. In the past, whenever silver surged too far, too fast, the same tools were deployed. Rule changes, margin hikes, liquidity withdrawals, narrative shifts, forced selling. The names changed. The years changed. The script didn't. By Friday afternoon, it was over. $10 trillion erased from screens. Commentators called it volatility. Analysts blamed excess speculation. Headlines moved on. But the real activity had already happened. Ownership had changed hands. Fear had done its job. And once again, the people who didn't understand the mechanics paid the highest price. That's the part of this story most people never hear, not because it's hidden, but because it's uncomfortable. It suggests markets aren't just arenas of chance, but systems with levers. And those levers are pulled at very specific moments. Friday wasn't chaos. It was the end of a process that started days earlier, weeks earlier, quietly and deliberately. You see that, you realize this wasn't the end of the story. It was just another chapter in a pattern that is repeated for decades and will repeat again. Now let's strip away the noise and look at what this event really was. What happened on Friday wasn't a failure of markets. It was a success of design. Every major move followed pressure points that have been used again and again throughout financial history. Margin rules, liquidity timing, policy signals, and psychology were all activated in sequence. Nothing was random. Start with margin requirements. Weeks before prices collapsed, the rules quietly changed. Holding silver and gold suddenly required more cash. Then more again. Each adjustment forced traders to stretch themselves further just to stay in the same position. Most didn't notice because prices were rising fast enough to mask the danger. That's intentional. Margin pressure doesn't hurt when markets are calm. It only becomes lethal when volatility appears. And volatility didn't appear by accident. It was triggered. The policy signal reversal was the spark. In 72 hours, the message flipped from weak dollar to strong dollar. That contradiction forced traders to unwind positions immediately. Not slowly, not rationally, immediately. Leverage doesn't allow patience, but leverage alone still wouldn't have caused a 40% collapse. That required one more ingredient, the removal of liquidity. Historically, when silver sells off, a massive buyer steps in. This time, that buyer didn't just hesitate, they stepped away entirely. Margin rules tightened overseas. Buying paused. The safety net disappeared. That's when selling turns into collapse. With no buyers, prices don't search for balance. They fall until forced selling ends. Algorithms accelerate the move. Stop losses trigger automatically. Brokers liquidate accounts without asking permission. At that point, human decision-making is no longer involved. This is where the illusion of a free market breaks down. Because while paper prices were imploding, physical reality told a different story. Vaults weren't emptying. Metal wasn't flooding the market. Contracts were changing hands, but the underlying asset stayed put. That tells you everything. This wasn't mass rejection of silver or gold. It was a paper unwind, a transfer of risk from over-leveraged traders to entities with patience, capital, and no margin constraints. In other words, weak hands out, strong hands in. And the timing matters more than most people realize. Month-end isn't just a calendar detail. It's when banks must clean up balance sheets, close positions, and manage liquidity ratios. It's when pressure is highest and when forced moves are most effective. The same timing has appeared before. When metals ran too far in past decades, collapses didn't happen mid-month. They happened at accounting deadlines, after rule changes, during policy confusion. Pattern matters. Now look at what happened after the crash. If this event were about protecting markets, pressure would have eased once volatility passed. Margins would have been lowered. Liquidity would have been restored. The opposite happened. Margins were raised again. That isn't protection, that's containment. It prevents immediate recovery. It keeps prices suppressed. It buys time for large players to accumulate quietly while public confidence is shattered. And while retail traders were forced to sell, who was buying? Central institutions. The same entities that publicly downplay the importance of precious metals have been increasing physical holdings at the fastest pace in decades. Gold has been replacing government bonds and reserves. Trust in paper promises is eroding, and insiders know it. That's the final reveal. Gold and silver aren't attacked because they're outdated. They're attacked because they expose weakness. When metals rise too fast, they send a message the system cannot allow. Paper money is losing credibility. So the price is smashed, confidence is shaken, ownership changes hands, and once stability returns, the cycle begins again. This wasn't chaos, it was a reset. I know how this feels. You watched numbers you worked years to build disappear in hours. You questioned your judgment. You wondered if you were foolish to believe in something real while everyone else chased screens. Let me say this clearly. Fear is exactly what the system relies on. Fear forces selling. Fear transfers assets. Fear hands control back to those who already have it. This isn't advice, it's observation. Markets move in cycles, not because humans change, but because incentives don't. When everyone feels invincible, risk is highest. When everyone feels broken, opportunity quietly forms. The question isn't what price did yesterday. The question is what you believe about the future, and who you believe controls it. If this analysis gave you clarity, share it with someone who panicked. Someone who deserves understanding before making a permanent decision in a temporary storm. Knowledge doesn't stop the system, but it keeps you from being consumed by it. We started with 72 hours, 3 days that looked like chaos. But now you see the structure, the setup, the signal, the reversal, the withdrawal of liquidity, the forced liquidation, the quiet accumulation. This wasn't random, it was familiar, and it won't be the last time. Every system defends itself when threatened. Every currency does the same. Gold and silver aren't attacked because they are irrelevant. They're re-attacked because they expose weakness. Paper can be printed, confidence cannot. And that's why these moments matter. Not because of the losses, but because of what they reveal. Now you know the script. What you do next is your choice. But remember this, you don't fight something this hard unless it matters. And resets always benefit those who understand the rules before they're enforced.